Hey everyone, it's Simon here. Welcome to your Accelerate Members Update for Friday, the 22nd of September 2023. We had a proper risk-off day yesterday. S&P was down 1.64% by the close, and seasonality, it's going right according to plan. I shared this with you in the barometer at the start of the month. The first couple of weeks of September, even though September's got a bad rep, actually have got bullish seasonality, and it's really only the last 2 weeks of September where the more bearish seasonality starts to come in. And certainly the seasonal probabilities for the end of this week are not looking bullish. The other thing that isn't looking bullish is the fact that the S&P has closed ever so slightly, mind you, but closed below the previous swing low just here. All right, so that could entice some people to want to add some fresh shorts. It certainly seemed to entice some panic hedges into the market yesterday. If we look at the put-call ratio, you can see that we had a big spike in put buying here. That's the biggest spike in put buying that we've seen, since the kind of the regional banking crisis back in March. And panic put buying always occurs after a market fall, all right? These people, they don't know how to hedge. They only buy puts when they are like a deer in the headlights. And what can often happen is, okay, they've lost money on their equity longs because they've been buying the dip. And so they're underwater on stocks. They rush out and buy puts to try and make some money or stem the bleeding. And then what happens with that rush to buy puts, the market can turn around. And all of a sudden, they're on losses in their stocks. They're on losses in their puts. And this is how traders become investors and how people get trapped. So just back to the S&P for a second. Look, it's bearish, okay? When you undercut a previous swing low, that has got bearish consequences. But I've been running some Fibonacci levels on SPY, which is the S&P 500 ETF. And I reckon this has run into a truckload of support. We are at the 1.272 Fibonacci extension of this swing in the previous direction. We've got another swing low just here that it's coinciding with. And we're also at the 50% retracement of this swing low here. So I wouldn't be surprised if the S&P manages a bounce in the next couple of days. I think it'll be short-lived. I think the trend has definitely flipped from sideways to down. But I don't think that today is a good day to be pressing bearish bets. Now, where could I be wrong on that? Well, the first chart I want to share with you is the VIX. So the VIX has had a bit of a surge to the upside, and in fact, the VIX is looking like it's broken out. Now, VIX breakouts can get messy quickly. A one-day surge in the VIX, there's nothing particularly bullish about that. Now, unless we're entering a legit sell-off, usually 2 closes above the upper Bollinger Band is all we get on the VIX. So we could certainly get another surge higher today, which would see the S&P push lower. But if we do get another push lower, and that would also fit with seasonality, to be honest, I think that we could be looking at a bullish bounce into next week. I don't know that it'll be a big enough bounce that I want to try and play it, but it's leaving me reluctant to place any more short bets right at this juncture. The other chart that is kind of eye-catching is what's happening to yields. This TNX is the 10-year Treasury Bond Yield Index, and this has surged to highs not seen since 2007. Now, we are 3 ATRs above the mean. I wouldn't expect it'll keep surging higher again in the short term, but if we run some fib levels, let's just go from this major swing here. Okay, you can see that the 1.272 extension kind of capped this rally in yields a couple of times. But if we look for the 1.618, that's sort of up here at 4.6%. So I think yields are likely to go higher, albeit not in a straight line. If we look at bond futures, which will be roughly the mirror image of that, you can see they've taken out this swing low pretty decisively. And just bear in mind that surging bond yields tighten financial conditions. They put downward pressure on equity valuations, and when you've got combined stock and bond volatility, it just causes risk-off type behaviors. What was characteristic about yesterday's price action was obviously the S&P was down. If I can get Thinkorswim to wake up, down 1.64%. The Nasdaq fared slightly worse. The Nasdaq was down about 1.8%, 1.84. If we look at global equities, MSCI World Index, that was down at 1.68%. Bonds obviously were weaker. If we look at TLT as a proxy, they were down at 2.57%. Gold, the so-called safe haven, okay, it's having a little bounce right now, but yesterday gold was down 1.4%. High yield bonds, they were down 0.71%, but basically everything was down, all right? And this is just a reminder that diversification is a risk management strategy that will fail you completely when you really need it. The only way to really manage risk is buying something that moves inverse to the way the rest of your portfolio does. And that is why we were buying those puts on SPY and triple Qs back in early August. And it's kind of ironic that it was only yesterday on Bloomberg TV they were celebrating 101 days without the index moving more than 1.5%. Their timing really couldn't have been any better. So that's a summary of what's happening. Let me run through my positions quickly. Obviously, all of the short positions, all of the puts we've got are working really, really well. And the other point that I want to, I guess, just reinforce is the fact that we didn't, we weren't in a downtrend, all right? When we put these put trades on, the market was choppy. And so they were all counter-trend trades, but it just shows you the power of having these counter-trend trades on in a choppy market environment. So American Eagle has had a lovely descent since we got set back here. Thanks for watching this video. If you enjoyed the video and you'd like to learn more about our programs, please visit us at taooftrading.com. That's TAOOFTRADING.com. Yeah, you can sign up and receive a free copy of the first chapter of my best-selling book and stay informed of any events that we've got coming up. Thank you.